Hello friends, I hope all of you are doing great. I'm back with another video which is on equity today, and I wanted to drive home 2 points. One is, how do equity returns get created? And second, what should an investor do to get best out of his equity investment? To make things simpler for all of you, I picked up 20 equity mutual fund schemes as an example. And just to put a disclaimer here, this is not any recommendation for investing in any of these schemes. The scheme selection is a process which is based on various factors through which you should select your schemes which is more suitable for your risk profile and for your portfolio. But here I just wanted to drive home the point of the pattern of equity returns. So here it is. Let's look at this chart. This chart basically contains annual returns from 2013 to 2022, thereafter simple averages for 10 years, 7 years and 5 years. Now let's pick up some illustrations out of these. Let's look at, first let's look at the ICICI Prudential Large and Mid Cap Fund. In the year 2013, it gave 11%, thereafter 38, then it gave a negative return, then 10%, 29, minus 6, 5, 11.7, 41.8 and 11.7. So it had about 3 to 4 years which it produced almost 10% or lesser returns. That means 40% of the time the fund has been not giving an average return of even 10%. Still the 10-year average stands at 15.39, the 7-year at 14.98 and the 5-year average is at 12.96. Let's look at another example. Let's look at the Kotak Small Cap Fund. 2013 minus 4.91, again in 15 7.36, 2016 it was 8.86, 2018 it was minus 17, 2019 5% and 2022 again minus 3. Still the averages was 21.93, 20.4 and 18%. Now what does this denote? This denotes, if you are an equity investor, you should not give up your equity investments if you have faced any 1 or 2 consecutive bad years. By doing so, if you exit, you will miss out the best years as well. And a bad experience once created in equity, investors generally don't come back to equity. So therefore, it is very, very important to understand how should you invest. Now to drive the point more deeper, I basically plotted their SIP returns as well. Look at their 5-year SIP returns, 10-year SIP returns, 15-year SIP returns. These are percentage returns. If you look at 10 years, let's take a median of the 10-year period, you will look that your SIPs would have produced a return which was in decent teens, where bare minimum was 13 and as high as it went to 18%, depending on the type of the scheme you chose for your portfolio. So if you are consistent over a long-term period, if you do not sway away from bad years, then you are going to get the average or even better than average returns. Let's look at how the money grows. Look at this 25,000 SIP done for 5 years, 10 years and 15 years. Look at the amount of wealth creation once you remain invested and continue with your SIP over a long-term period. Now the minimum point I want to drive today is persistency and perseverance are the biggest assets of any investors. If they practice this, they are bound to create wealth, which is going to be superior than the next best asset class, which is real estate, and far more superior than your bank deposit, because end of the day you will have all these three in your portfolios. There will be debt, there will be real estate, there will be equity, but equity will be the return puller, and for that you need to adapt to the nature of equity. I hope I could drive some important points for all of you. I'll come back with more informative videos and look forward for feedbacks from all of you. Thank you.